Which asset is going to give you the best bang for your buck in the long run? Should you invest in stocks or look at putting your money in real estate? Well, property is a great way to grow your net worth and is generally favored amongst the wealthy. Here are some critical issues you need to consider carefully. Hi, my name is Pauline, and I'm an investor, educator, and author. I've recently held a talk with my good friend Jack Cozy, and he brought up some very interesting thoughts about property versus stock investing. So if you're having trouble deciding, this one's for you.
Now, you might be saying to me, Jack, I'm in Singapore, I'm in Malaysia, I'm in the US, I'm in Australia, property prices are going up. Why don't I just buy property, right? It's been a really good asset class. It's done really well. You're telling me it's going to go up over time, and I am an owner of property as well. Why don't I just buy a property? That could be a good asset class. And yes, it is. And Pauline owns property, and as you diversify, you will get to do that. But property comes with its caveats, okay? And here, let me explain it to you. This is why I believe that the stock market is the greatest wealth creator in town. It's because it's a low barrier to entry, right? You don't need much money to start with the stock market. In Australia, you can buy stocks from as little as $500. In the US, you can buy one stock, and that stock can be $1, 50 cents, $10. So your barrier to entry is very low. The other thing about property versus stocks is it's not liquid. In terms of liquidity, and if you don't know what liquidity is, guys, it's your ability to access your cash very quickly. Now, with stocks, particularly as value investors, we only look at liquid markets. That means if you want to be in or you want to be out, you can get out in a second. Property doesn't give you that. You've got to get a real estate agent, you've got to put it up for sale, you've got to get people to show you in your house, etc., etc. And it's very illiquid to get in. It takes time to buy a property if anyone's bought one. But the other thing that property carries that stocks don't carry is that L word, and that's leverage. And leverage can be good, right? But it also can be bad. And as we've seen property prices go up, and remember, stocks don't require leverage to enter, what we've also seen is debt balloon, right? Debt has ballooned all across the loan. So I'm going to show you some global figures, and I'm going to show you some Australian figures. In Australia, if you look on that left-hand side of your screen there, guys, you can see that the average loan size has gone up considerably, right? On the right side, you can see the amount of money that people have leveraged up. So in New South Wales, from 1993 to 2018, we've increased our debt by 370%. Victoria, 417, 339 in Queensland. If you look at that bottom figure, and this is the issue that I have, is that housing affordability is becoming a major issue for Australians, with borrowers needing to dedicate 135% of their gross income, that's before tax, for just a 20% deposit. So when we talk about the barriers to investing, the barriers, not the necessity to invest, the barriers are growing up. And everywhere in the world, you need a loan to get into property, not just here in Australia. You can see that not only is it happening with first home buyers, but it's also happening with investors. The need to invest in property is requiring us to increase our leverage and our debt. Now, what's the issue with debt in this environment? Why is debt such a ticking time bomb in this environment? And there's a word for it. It starts with I and it ends with T. Right, interest. We are in a low interest rate environment. In fact, as you know, as an economist in a number of numbers, we are in the lowest interest rate environment ever in human history. And while we're doing that, our debt continues to rise, right? On the left-hand side is debt to GDP ratio across the globe. And on the right-hand side is debt to GDP ratio in Australia. Now, for you Australians in the crowd, just let me say this to you as a fellow Australian, for every dollar of output we create here in Australia, we have $2.20 of debt, or just under, double the debt. Now, this is a phenomenon that's occurred across the globe because interest rates are quite low. Now, what are interest rates? Interest rate is the cost of money. Inflation is the deterioration of money. Now, we are in a low interest rate environment and have been for a long time since the GFC. We've been going down. And if you look at the Fed rate, it's practically at zero. Most economic developed countries in the world, including emerging markets, have been going down in interest, creating a pool of debt. You borrow for cheap, you invest in assets, and property is the biggest one that's happened. What I can tell you, well, actually, I'll start off with what I can't tell you. I don't know when interest rates are going to go up. The Fed in the last couple of days has told us that they're flagging early to 2023. And everybody tends to follow the US, okay? They still tend to be the leader of the world economy, even though those of you who have talked to me, you'll know that I'm a big China buff. But what I can tell you is that they will go at time. Because while history doesn't necessarily repeat itself, it rhymes, guys. This is a chart of US interest rates dating back to 1790. And you can see, what you can see there is interest rates go up and interest rates go down. And also, if you can see that we are nearly at all-time lows, there's nowhere else to go. This doesn't take in 2020 because they're at zero. And what we've learned from the Europeans is that negative interest rates are not a good thing. And the biggest problem with living in this world right now is that asset prices have gone up, interest rates have gone down, and this might be a ticking time bomb. Because in front of us, things are getting more expensive. Do you agree with me that things are getting more expensive? Food, electricity, goods, cost of services. Can you see it? And when things are getting more expensive, guys, what do we call that word? What's that word? It's inflation. And the only way you can counter inflation is through interest rates. And all around us, guys, things are getting more expensive. Education is getting more expensive. Universities, college, private tuition, books. The need to increase your education so you can get a better job and increase your livelihood so you can have your wants is also increasing. But it's all around us. Power, petrol prices, grocery prices. Every time I go see my mother, she's always complaining. Fish prices are up. Meat prices are up. Chicken prices are up. Vegetable prices are up. It's like, Mum, where's the steak? No, it's too expensive. But I come here for the steak. Water's up. Healthcare costs are up just to keep us healthy. Housing we've talked about. Education we just talked about. It's getting harder and harder. It's getting harder and harder. And the need to invest is no longer about getting ahead. It's about staying in line.
I hope that gives you some perspective. Remember, profitable investing takes advantage of time to produce the best results. So whichever asset you choose to invest in, get yourself equipped and start as soon as possible. And if you like this video and want to learn more about investing, then be sure, hit that like button and click subscribe. I'll see you soon.